Thanks for joining me today. The 2 decades following World War II were heavily influenced by Keynesian economics. That brand of economics said that inflation and recession could not occur at the same time. Inflation was the result of excessive economic expansion, and deflation was the result of recession. Since you can't have expansion and recession at the same time, by definition, you can't have inflation and recession at the same time. That theory was debunked in the 1970s when both the UK and the US experienced inflation and recession at the same time and for 10 years, including the period 1973 through 1982. The purpose of this broadcast is to take a look back at the 1970s, particularly the stagflationary period of that time, and understand any takeaways useful for today's economic condition. Ask you to look at the next slide. Okay. First, it's generally believed that a modest and consistent 2% level of inflation is just fine. A slow rise in prices gives flexibility for relative pricing to change without actual price or wage declines. Second, unexpected inflation is not okay. It creates uncertainty and leads to increases in interest rates and a potential recession. Third, the lesson of the 1970s is that inflation doesn't self-correct, just the opposite. Inflation recycles and contributes to higher inflation in the next round. It's interesting to note that Richard Nixon tried price controls to break inflation recycling. It didn't work. Stagflation creates serious problems for investors. Bond prices drop because interest rates go up. Stock prices fall from lower PE ratios and declining earnings per share. Third, the correlation between stocks and bonds turns positive. Bonds are no longer the risk-off asset in this new inflationary world. A role bonds have played for 3 decades no longer exists today. Finally, there are few options for wealth preservation. Cash and floating rate securities are probably the best protection for investors that want to preserve wealth. Slide 3 shows the historical inflation rate in the US from 1954 through September 2022. As you can see, interest rates averaged just over 3% for this 7-decade period. There have been 2 periods where inflation jumped to much higher levels, the 1970s, and more specifically 1973 through 1982. And also today, 2022. In both stagflation periods, inflation averaged just over 8%. Now for the bad news that occurred in the first period of stagflation in the 1970s. First, GNP growth was very sluggish, averaging 1.5% and about 2% per year below the prior and subsequent decades. Second, short-term interest rates rose to an average of 9.4%. Third, the real value of stocks dropped 38%, and the real value of bonds fell 48%. The only traditional asset class that was a safe haven was cash, but even there you lost 2% of your real value. Interestingly, prices for both gold and oil doubled over that time period, but this was probably more idiosyncratic rather than inflation related. Oil prices jumped as a result of the 1973 Middle East oil embargo, and gold jumped because Nixon in 1971 allowed the dollar to float against gold, where prior to that it was fixed at $35. The lesson learned from the 1970s is that stagflation is very damaging both to the real economy enter the capital markets. Okay. I conclude with slide 4. There are two inconvenient truths. The first is that to cure inflation, interest rates have to go up significantly and exceed the rate of inflation. The second is that recession seems almost required to tame inflation if history is to be believed. And in the case of the 1970s, it took 3 recessions to get inflation back to its long-term 3% trend rate. Fast forward to today, neither of those conditions exist. We have 8% inflation, but interest rates are at least 4% below what they need to be. Second, we are not in a recession, and it looks like we may need one of unknown magnitude and duration to fix this problem. That, unfortunately, is the inconvenient truth. But maybe it's different this time, but I doubt it. Thank you for joining me today.